Hey everybody, welcome. My name is Matthew. Thank you so much for joining. Today I'm going to take a look at Federal Reserve policy interest rates from the 1980s all the way until the global financial crisis. Okay, so here's our 108, 109-year history of the Federal Reserve. Again, its balance sheet and interest rates. Happy Easter, by the way. For those of you celebrating such a holiday, and for those that don't, I hope you have a wonderful start to your spring in the Northern Hemisphere, or a start to your fall, I guess, in the Southern Hemisphere. I would encourage you to check the last few videos regarding what the discount rate is, what the federal funds effective rate is. We're going to start in the 1980s here, when Paul Volcker had already taken interest rates to historical highs, not just in the United States, but in the history of the world. Again, you'd have to go back to ancient Greece or a little bit farther, ancient Sumer, to find 20% interest rates that were systemic. I'm not talking loan shark rates, I'm talking systemic rates. You'd have to go back a long, long time to find such high rates. So we're going to start here, and we're going to go down to the global financial crisis. Also, I do know that this series on the Federal Reserve's weekly balance sheet is getting a little bit long. Sometimes I start a series and I'm not expecting to make so many videos about the same chart again and again and again. But I think it's helpful, and this is the first time indeed that I'm talking about interest rates, so it makes a lot of sense. So let's zoom in here from, let's say, end of the 1970s to the global financial crisis. And you can see already I got a lot of stuff in the timeline here around the global financial crisis that will make sense when I zoom in. And actually I didn't zoom in correctly. Let's go a little bit even farther so my tooltip doesn't get too much in the way. There we go, that's much better. Okay, so all-time interest rates here, pricking the gold bubble, pricking the inflation problem in the United States and beyond. Many countries actually suffered from stagflation during this period. That is rising price inflation and rising unemployment. Paul Volcker decided to prick this bubble, stop this problem by taking interest rates to all-time highs. We have the discount rate again. That's the rate that the Federal Reserve is supposed to be their emergency rate to banks. And we have the effective federal funds rate, which is the weighted average of the interest rate that banks lend reserves to each other. And reserves you see there are in dark green, not the light green, dark green. This is really this is high-powered money that really matters in the banking system. And you can see it exploded after the GFC, as we've talked about many times. But now we're going to talk about how this sort of works in general and what happened leading up to the GFC. So the story I'm about to tell you is relatively known, perhaps known to you if you follow finance at all. It very much mimics the interest rates that we saw here in the 1920s after the 1920-21 depression and leading up to the Great Depression. It very much mimics that. And basically, once the hard work was done by taking interest rates to all-time highs, we started a 40-year bull run in bonds and fixed income, which basically we're perhaps coming out of right now, or perhaps not, if they choose to continue to have perennial low 0% interest rates, and in some countries, indeed, negative interest rates. Negative interest rates are a historical anomaly, never have occurred ever, and the fact that they are occurring now is extremely dangerous. It's problematic. But luckily for the United States, they have never taken rates so low, and that has at least been the one good thing for the dollar and for the system. But basically what happens here, so Volcker, immediately after he does the hard work, he does ease up, okay? And Austrian economists were talking about how this was dangerous again, even easing up so quickly in the early 80s. And then we get to 1987 here, and the famous Alan Greenspan of the Greenspan put comes in. You see a few spikes here in the Fed funds rate due to market uncertainty. That actually wasn't Black Monday. Black Monday was 1987, October, somewhere around here. It would be somewhere around here, I guess. Not too much happening in the federal funds rate relative to before. It was a little bit higher, 8.38%, and then dipped down to the target close to 6% around Black Monday. So interest rates did fall during that crisis, but not so much. In any event, what happened here basically from when Greenspan came into the Federal Reserve in 1987, the discount rate is becoming less and less important to the Federal Reserve. As I talked about in the last video, the discount rate is now under the Fed funds rate, the effective rate that banks are lending to each other. That's a problem. That doesn't make any sense according to Bagehot's theory. Yet that persisted for basically from the 60s until 2003. I'm going to take away the discount rate after I show you the new rate that they started to target at the start of the 80s. And what was that? That was the Fed funds target rate. So here you see this is in purple now. They started this, not so explicitly, but I guess most explicitly in the early 80s here. I have the data from October 1982, where you have a Fed funds target rate. Don't worry about that lower, parentheses lower for now. That's after the global financial crisis. There's a lower bound and an upper bound. Until then, of course, in most of the cases with any bank targeting interest rates, there was never a range, there was never a corridor, there was never any of this stuff. There was just a target. So anyway, you can see that the Fed funds target rate is sort of what they're going towards to say, okay, this is really what we want to do when we're a central bank. We're targeting the Fed funds effective rate. But the target rate, of course, as the effective rate, it's still above the discount rate. So it doesn't make any sense according to Bagehot's theory. The discount rate is supposed to be at high penalty interest for good collateral when a crisis happens. You can see that that's precisely not what the discount rate is. It's basically under the entire time. It becomes less and less important regardless. The Fed funds target rate takes over in the United States as being the premier target interest rate that the Federal Reserve sets. And how do they set that? By manipulating the value of reserves, the dark green portion that you see on the left axis, which isn't that much money compared to post-2008, 20, 30, 40 billion at any given time. Okay, so let's take away the discount rate now. It's becoming less important. Now we just have the federal funds effective rate in orange and the target rate, which they set at their meetings every couple weeks in purple. So you see here, just going through the 80s, you're going above the target, below the target. And how do they do that? Well, when they want to bring rates up, you can see that they take the reserve supply sideways or even down. When they want to bring the target rate down, they bring reserves up. And they do that in the former case by destroying reserves, that is, selling bonds, taking the cash that they just earned from selling, destroying it. And in the latter case, that is, targeting a lower interest rate, they buy bonds and they create money ex nihilo and deposit that into the banking system ex nihilo, and they buy bonds from banks. So this is the high-powered money. This is the core of the system. This is the ledger-based bank reserve account. You can see basically interest rates go up, reserves are sideways to going down. Interest rates go down, reserves are going up. And that's how the trend works. So Greenspan comes in here towards the end of the 1980s, 1987. He takes rates up here. And then basically what happens, and I'm not illustrating this every time, it's not that difficult, but the theme is basically when he takes rates too high, and of course he can't know what rates should be, when he takes rates too high, the economy slows down. So what does he do? He drops rates. Okay, so rates go and everything's fine, but then apparently there's a little bit of inflation that's running hot. This was the Bush years, the end of the Soviet Union, also the Gulf War. Slows down just a little bit, but then uncertainty in the market, you're gonna have to take rates even lower to the mid 90s here. Now the Fed funds target rate is 3%, back to pretty low historical levels. This goes on to the mid 90s, 93, 94. Well, there's probably inflation coming into the system. Again, we don't even have to show you the inflation. That is the price inflation numbers. The very nature of the Fed raising rates suggests that inflation is running too hot because, of course, they can never find equilibrium themselves. They're just a planning board, the pretense of knowledge, as Friedrich Hayek famously has said. So they take rates up. And once they take rates up, there's, of course, problems. They have to take rates down again. Now, they didn't take them down too much here in the mid-90s. We also had the massive amounts of innovation occurring here. This was the birth of the World Wide Web in 1995. The dot-com boom and bust, of course, happened during this period, 2001, just before 9/11. Rates are sideways, a little bit down, and then start going even down more in the late 90s. And then, of course, this is when the NASDAQ bubble is pumping, pets.com, plenty of other domains, which, there is plenty of innovation happening, but there's also some craziness. And so they decide we've done too much. We got to take rates up. That's precisely what causes the bust. This is the dot-com bust coming here in 2001. The bust occurs. Whoops, we got to take rates down, down, down again. We even passed here Y2K. We passed 9/11, but the theme is pretty clear. So basically, this became known as Greenspan's put. It was basically anytime the markets were a little bit shaky, Greenspan would drop rates, and to the point where if he dropped them too low, he had to raise them again to choke off the price inflation. The same concept that was happening before with the discount rate. Now the Fed funds rate is kind of taking over as the premier rate to do this. So this is known as the Greenspan put. And to now, where we have this post 9/11, post dot-com boom and bust here in the early 2000s, Greenspan decides we really got to put up the gas as far as monetary easing goes. And he takes rates all the way down to 1%. And then this is about the time, somewhere in this period, I'm not sure exactly, when the New York Times called Greenspan the maestro for basically so adeptly and so smoothly getting the U.S. through the disastrous dot-com boom and bust, and then, of course, the tragedy of 9/11. During this period, he came to be known as the maestro. And basically, the U.S. could do anything with its dollar strength. It was a very unipolar world. There was no problems, and that was that. Of course, now there were other problems in government coming from the Bush administration. Lots of war debt starting and being created. The invasion of Afghanistan first, and then Iraq in 2003. Problematic. The birth of the housing bubble as well started during this time. Paul Krugman, the gentleman that thought the internet would be no bigger deal than the fax machine, famously said, if you follow my circles, that we actually need a housing bubble. During this time when markets were a mess and Greenspan was crashing rates to trying to save markets and save America, and it's all so problematic, he was saying we need a housing bubble. He actually called for a housing bubble here in the early 2000s. And what did we get? Sure enough, just a few years later, a housing bubble. So notice again, anytime the markets are in trouble, he will drop rates. It's become known as the Greenspan put. Eventually, it became known as the Bernanke put when Bernanke took over from Greenspan. But anyways, so we're finally at this point now where interest rates are at near historical lows, near all-time lows. 1% interest rates are as low as it could feasibly get up to this point in 2003. So what happened here? A lot of people started taking adjustable rate mortgages, short-term, easy credit for the first year, the first 3 months, at very, very low rates. But of course, they were going to adjust higher eventually. And there's a big risk there if interest rates go higher that you would have a much higher payment than you could afford. Of course, that's what happened. The rest is history. And there's just a boatload of financial engineering that took place on top of that. Anyway, rates go higher and higher and higher now because inflation is coming hot. The housing market is coming hot. Greenspan is raising rates all the way back to 5.25%, which is, that is back to 2001 levels. Greenspan basically, he set the stage, he set the table for all the pandemonium here with historically low interest rates, realizes there's a problem, as always, as they do, raise rates, and basically you get to a point where you're going to choke off the market. How high that number is when you're in the moment, when you're there, sitting there at the Federal Reserve meeting, of course you have no idea. The pendulum typically doesn't stop perfectly in the middle, it usually overshoots. So they did raise it here in 2006, and they stopped at 5.25. Bernanke, he took over somewhere here in 2006, where, let me actually not zoom in at this point. Let me zoom in here. The Fed funds rate is at 5.25%. From this point, we start to see cracks in the system. The first one here, and this is what I'm going to zoom in, is Bear Stearns liquidates a couple subprime funds. This was already in August of 2007. Bear Stearns eventually got liquidated in 2008, but this was the first major hiccup where these CDOs, collateralized debt obligations, or CMBS, commercial mortgage-backed securities, basically collateralized real estate loans that would trade like securities, repackaged, and everybody thought that they were very safe because they were somewhat diversified with different tranches, different types of borrowers. The story's been told again and again and again. We start to see that the theory that these little credit instruments that are mortgage-backed, everybody's supposed to own a home, wasn't as safe as everybody thought, and that was the first crack. So Bernanke, for the first time ever, starts his Bernanke put, all right? And he starts that in 2007, starts lowering rate, actually even before the market's fully tanked, okay? You see the Fed funds is following it, pretty lockstep here, okay? He's already now down to 4.25. Now he's down to 3 at the start of 2008. Now he's down to 2.25. Now he's down to 2. This is a pretty aggressive move before anything really happened on Wall Street. Now, the banks, of course, in hindsight, we know that they were all through this period starting to uncover how bad their books were. A lot of it wasn't public yet, but this is surely why the rates were falling as fast as they were. And Bernanke, as I've said many times, he told Milton Friedman on his 90th birthday, we will never make the same mistake of not providing enough liquidity to the market. We'll never make that mistake again. So he's ready to go. But now we get into the thick of the crisis here, okay? This is September, October 2008. And I have a timeline here. I'm going to zoom in even more. Let's look at what happens. All right. The first big one was, and by the way, this is weekly. So when I put this together, I might be a couple days off here or there. I'll try to recall. Fannie and Freddie. This was the state government agencies that backed a lot of the mortgage-backed securities. They had to go into conservatorship. Basically, there's no money there because they realized that the packaging up of these government-backed real estate loans were so terrible. That happened on September 10th. A week later, the next Federal Reserve balance sheet. These are Wednesdays, by the way. So again, right around September 17th, I don't know exactly which day, Lehman files for bankruptcy. AIG gets taken over by the U.S. government, and the Reserve Primary Fund, which is actually a money market fund, kind of like a stable coin, a money market fund that pegs its reserves to $1. This is a non-bank entity which had a lot of mortgage-backed securities, broke the buck, as they call that, basically depegged and lost its value to the dollar. Eventually that had to go under. That was the oldest money market fund in the country. The Reserve Primary Fund went under. Mortgage-backed securities struck again. Here we have central banks the very next week. Worldwide, we're starting to see that this is a worldwide phenomenon. Iceland is making a lot of noise, Norway, many other countries. Central banks start doing currency swaps around the world, led by the Federal Reserve. If you are illiquid in your own currency, take a currency swap with the dollar. We'll do what we can. We'll sort it later. JP Morgan, they purchase WAMU, Washington Mutual. Again, mortgage-backed securities, bad assets basically that banks, hedge funds, pension funds had bought. They were all going under. Now notice here what's happening. This is interesting. The Fed funds rate, the effective Fed funds rate, it's higher than the target here at the worst day. This is probably the worst day, the worst week of September 17th when Lehman goes bust. The Fed funds actually peaks above the target. All right, it hits 2.8% when the target was 2. But now look what happens here. It starts to go under, starts to go well under. It's 1.15. The target is 2. Goes above again here. And now Bernanke starts to lower. And so we're up again. So it's kind of, you can argue it's still kind of straddling. But more bad news keeps coming. Markets are falling. This is the worst day. It's actually October 24th. I wrote that one down. So I have the 22nd week here, October 24th. A lot of world stock markets crashed. 10%, 20%, really, really bad. This was one of the worst days. So notice what's happening here. The target rate is lower than it just was a couple weeks ago at 1.5%, but not so low. And the Fed funds itself is falling more. The Fed funds is now at 0.81%. This is the rate that banks are lending to each other. They're lending at cheaper and cheaper credit to each other. Okay, Bernanke lowers again to 1%. 1% here, October 29th, 2008. Fed funds is now lower still. It's at 0.36%. Next week, Fed funds is at 0.23%. Next week cools off a little bit. Rate goes back up to 0.35%, 0.38%, 0.53%, but down again in December. We have Madoff coming here in December. The Fed funds goes as low as 0.11% on a weekly basis, when Bernanke still has the Fed funds target at 1%. And from this point, when the Madoff Ponzi unravels the next week, he takes them down to 0. So it's very interesting here that as the credit markets were imploding, and this was a case of banks and non-banks completely imploding, banks were actually lending to each other well under the target. This is a big gap, 1% or so under the target, where if you look at any other point in history, such a long, many week trend of being well under target just didn't happen. So this actually shows a couple things. One, it shows how influential the banking system actually is. But more importantly, it shows that they are waiting for a bailout. They're waiting for a bailout in the form of lower rates, in the form of cheaper credit, because they're not really going to wait for the Federal Reserve to do it themselves to say that, okay, this is going to be the target rate. And of course, you see the reserves now are exploding, going from basically, the balance sheet in total under $1 trillion, and the reserves at this point under $10 billion in September of 2008 just start exploding from this point. And if we back this off, we can see that this eventually, that just, $5, $10, $20 billion in reserves turns into trillions and trillions of dollars, which has continued on to this day. So a completely different monetary epoch has occurred. One more thing that happened here after the Madoff Ponzi imploded and Bernanke decided to take markets to 0%. And of course, I didn't catch everything in the timeline. Remember, there were a lot of fiscal stimulus that occurred besides a lot of the bailouts. Again, weird inconsistencies, and that Lehman and Investment Bank failed. AIG was bailed out. Other glaring inconsistencies as well. But this is basically, interestingly, how it happened is the market is expecting lower rates well before the Fed actually gives it. And the Fed indeed complies finally by early December 2008. And then they just do this kind of goofy, this isn't the corridor system itself, but they start a corridor among the Fed funds target itself by showing now just not one target rate for the Fed funds, but a lower and an upper bound. So I've now turned the target rate into the lower bound, which is now 0, for the first time ever being 0. But of course, they try to be fancy with it and say there's an upper bound of 0.25%. And this has continued to this day, basically a quarter point being the delta there between the lower and the upper bound. And they're trying to have the Fed funds rate stay inside of that range. So there you go. That is a little bit of a quick history of the Greenspan put into the Bernanke put into the global financial crisis, into the eventual explosion of bank reserves, which we have talked about before, and we will talk about certainly again. In our next video, we will explore another interest rate, which they added precisely at this time, the interest rate on reserves. Thanks for watching.